Howdy, Jacob here. Today we're looking at Cable One in the media industry, 1.9 billion market cap on 5.3 billion enterprise value. So much net debt here, similar to some other media companies I've looked at, but don't like that. It's a rough start. Revenue growth is very impressive from 10 years ago, but really pretty much flat the last couple years. Gross margin up a lot, operating margin up a lot, so they're being more efficient with the money that's coming in, and operating margin of 30% is crazy impressive. Dividends, huge dividend, but it is not an excessive amount of their earnings per share, so that's positive. Return on invested capital, mid single digit, so not really anything to brag about there. Balance sheet shows 190 million cash on hand with 19 million short-term debt, 3.6 billion long-term debt. That 3.6 billion long-term debt is this other is their capital expenditures, so maybe we're looking at 300 million. I mean, that's 12 times their 5-year average free cash flow. I mean, it's an excessive amount of debt. But again, I've seen companies like this. This might be too much for me personally. There's always a level, right? I mean, you have to understand when the debt is due, and whether you're comfortable with them paying it back or not. It looks like the last 3 years they've paid a good amount of that debt, but they went into an excessive amount of debt issuance here to fund an acquisition. And so I don't think it's too bad to go into debt to make some acquisitions, but I think that much in debt in relation to your earning power and free cash flow is a little bit too excessive for me. That one time 1.6 billion is over 5 times their 5-year average. And so I'm I'm again, you're going to have to do what you're comfortable with and understand whether you are willing to invest in a company that with this much risk. I think if it's cheap enough and they're able to really focus on debt reduction and you're confident that that's going to be able to happen, absolutely there's a price for it, but I think the margin of safety has to be quite immense. So on the revenue growth side, let's do I mean, they make a lot of acquisitions, but I need to assume that they stop making so many acquisitions because they're just going into debt for this. So I think without acquisitions, probably comfortable with 3%. And then for margins here, let's do 17 and 19. Let's do the average, what we saw. Their dividend, I mean, that payout ratio is pretty small, 67 million in relation to about 300 million. Free cash flow is really not substantial, about 20-25%. But we're really going to have to focus on debt reduction here. So I think I'm fine keeping that the same. What have they done historically? Increased it a tad. I might just keep it the same. And then have they repurchased shares recently? Yes, they have, but I'm going to say they just offset stock-based compensation. So I'm left with 30% capital allocation towards debt reduction. So for me, I mean, that difference is crazy. These assumptions are saying that 10% to share change, 20% to their dividend, maybe 20% to get these types of returns, and then 50% to debt reduction. Whether that's enough safety for you or not is a different story. I mean, for me, I'd probably have a conservative PE as well as a larger discount rate, saying that, at the end of this period, they're still probably going to have maybe twice as high enterprise value if they do it this way. And then I don't know if they will. So I'm going to need an extra margin of safety on top of that. Again, this isn't the price that I'm necessarily buying at. This is just before I do more research. Yeah. But again, there are some companies you're just not confident in that they're going to do what you want and when it comes to debt, and that 12 times your 5-year average free cash flow on debt is something that I don't like to play with too lightly. Hopefully you enjoy the video and have a great rest of your day. Thank you.